That's a good time for us to get in Mr. Sanjay Sinha. He is founder of Citrus Advisors. Thank you so much for joining us, Mr. Sinha. Every time we hear people say that the correction is in the offing and there is a lot of froth in the markets, the next day we see some long hands come in, some funds come in and start buying. So what is your view? What is likely to happen?
So I think, the uncertainty of the market is more to do with the short term. And I think on the medium to long term, there is fair amount of conviction as far as the trajectory of the Indian equity market is concerned. And, if you see the way the market has behaved over the last 4, 5, 6 months, it has also given a rise to that feeling that, if you are going to take a short-term call on the market, you might actually end up losing out on the big moves. So on the day of the budget, the Nifty was somewhere around 6,800 points, and we have had a very scorching 2,000 points plus rally in the Nifty in the next, I would say, 6 months. Now, at every level, when we were rising from 6,800 points to now to almost the threshold of 9,000 points, there was that skepticism about the market in the short-term moves. And I think that has kept a large amount of money outside the market. At this point of time, one thing we cannot deny that, there is an event risk in the short term, and that event risk could be significant. But whether that will lead to a large-scale retracement of the market, I think on that the view is divided. Because the Brexit came and went, and we saw that the impact on the market was not very long-lived, and the index actually climbed very fast and much higher. So I guess the view locally, and I think that is a fairly significant view now, is that at every correction of the market, people are waiting to step in. And I think that is the one which is giving that fair amount of support to the market. Added to this is also the fact that, the last time that we visited 9,000 points of Nifty was in March of 2015. After that, 7 quarters have passed. At March 2015, we looked prospectively at an earnings decline. September of 2016, we are looking at an earnings growth of almost double digit in FY17. So prospective view is much more positive, and I think that is also something which is supporting this up move that you are seeing and the support that is coming to the market.
What is the historical kind of PEG ratio at which the Nifty trades? And here I'm using PEG because the Nifty trade is based on a consensus idea about growth and a consensus figure as to Nifty earnings. What is the historical rate at which it has usually traded?
So therefore, that number has been in the region of about 17 or so.
I'm talking about the PEG ratio because
somewhere close to that number. If you're looking at a near-term earnings outlook for FY17.
So I'll just complete my answer here. A question here that if I look at the PEG ratio, because earlier when we've seen the PE expand to that 17-18 level, the earnings expectations have been higher than 9.5% that we're seeing right now. And in fact, I think we started up with high double-digit growth for FY17. We've now gone down to, we then went down to 12%. Now we are saying about 10 to 11%. On the bottom end. Of course, there are still a lot of outliers there. What is the PEG ratio? Because the PEG ratio seems to be higher than historically what it has been.
So, you have to see that also in the context that, we now are going to complete 2 quarters of the financial year FY17. And within the next 3 months, we will now be looking at the prospective outlook for FY18 along with what is going to be the earnings outcome for FY17. In that background, even if we have now recalibrated the earnings outlook to say 12% for FY17, the earnings outlook for FY18 continues to be very strong. And this earnings trajectory that we are expecting is largely coming from the financial sector. One of the key reasons why we closed FY16 with a disappointing earnings growth for the larger indices was the fact that the banking and financial sector, and particularly the PSU banks, disappointed in a very big way as far as the earnings expectations are concerned.
Right.
And mind you, they also form a significant weight in the index. We also had a fairly disappointing year as far as the commodity based companies were concerned. FY17 is not that bad. So I have a point of view that this 12% earnings growth that we expect for FY17 may not necessarily dictate a PE ratio of the Nifty at somewhere close to 12, 13 or so. It might actually be looking at the earnings growth for even FY18. And therefore, that level is giving a fair amount of support to the market.
Right, but if I look at the kind of numbers that if one takes the larger share of 500 or more companies into picture, then the earnings growth appears to be much lower, right? I mean, we are talking about the Nifty, but if I look at mid-cap index, we look at the small-cap index, they are moving at a much faster pace. So it's difficult to justify these in terms of earnings. It would probably be easier to talk about liquidity, right?
That is one factor, but you cannot discount the fact that the earnings growth in the mid-cap companies actually is much stronger than what we have seen in the large-cap companies. See, in the Nifty and the Sensex, you have a fairly large proportion of banking and financial services. You also have a very large proportion of companies in the commodity sector represented in these two indices. You go down the other indices, the mid-cap indices, you will find many more companies which have an exposure to engineering, construction, or to put it in a very generic way, more domestic focused companies are those which you will find in the mid-cap indices. There, even the current year has been a very, I would say, a good year for them because the earnings trajectory growth there is much better. No doubt, the surge that you have seen in the stock prices of the mid-cap stocks is not only explained by the earnings growth. It is also explained by the fact that, yes, there has been a fair amount of liquidity that has been chasing them. But, there was also a fairly long period in which the mid-caps were out of favor. And all the money that was coming into the market was largely looking at the large-cap plays. Why do I say that? I think if you look as to where much of the flows to the mutual fund industry has gone, in the last 2 calendar years, I think, the net flows to the mutual fund industry has been to the tune of about 75,000 crores per annum for 2 consecutive years. Now, 1,50,000 crores of money which has come to the mutual fund industry has come in a very large proportion to the mid and the multi-cap oriented funds. And therefore, that money has also ended up chasing these mid-caps. And of course, the retail, local retail participation has been there all through.
But Mr. Sinha, I was looking at a report in the Economic Times which they came out from the ET intelligence group that they have, ETIG, and they calculated the earnings of 3,008 companies, if I remember correctly. The number, somehow I remember the number, odd number, 3,008 companies which had declared results till then, and this was at the end of August. And they said that the total earnings of these 3,008 companies, if you look at it on an annualized basis, has gone down by 3%. It has actually not gone up. So they're actually a wider amount of the listed space is actually performing worse than it has performed in the past. But if we look at all the indices put together, they are doing much, much better. So I understand you're saying future earnings, but the markets and analysts appear to have got future earnings wrong for the last 3 years.
Yeah, so on that, I would say that, looking at that aggregate number might not be the right way to look at this thing. Like take, for example, without being company specific, look at the results of Coal India, for example.
Right.
Last year, they had close to about 14,000 crores as a PAT, but large part of that actually came from the interest that they received from their bank deposits. Now, with the cash reserves of Coal India now depleted, you don't have that sort of earnings in the favor of Coal India. Now, you would need maybe thousands of mid-cap companies to measure up to 14,000 crores of an aggregate PAT in a quarter.
Right.
So that aggregate number actually ends up being a little deceptive. I think what you need to do is probably break it up into sectoral composition and see whether sectorally is that trend overall giving a very negative picture.
But on the other hand, the Reliance numbers kind of balance out what Coal India has done, right? Because Reliance had this absolutely outstanding numbers which no one expected. That balances out. So while you have a Coal India, you also have an outlier like Reliance.
You also have a Tisco?
Right, absolutely fair. I get your point. I understand the point that you're making, that essentially look at it sectorally. My second part of the question, and I'm making these questions long because of the delay and the gap we have in this communication, I'm sorry about that, was that if I look at the Nifty or the Sensex earnings projections done in the past 3 years, all of them have been overestimations, and overestimations by quite a bit. So, if an investor is watching now, what has changed that overestimation will become an underestimation this time?
Okay. So on that count, I will say that, we will never reach that perfection where the analyst estimates of an earnings will be the ones which will be actually matched with delivery. Markets will always move in cycles, and there will be cycles which will get created by optimism and pessimism.
Right.
Now, look at what actually happened to the market over the last 2.5 years. When the new government came to power in May 2014, there was a general belief that the earnings would improve dramatically. And therefore, the market did not wait for the earnings to get better. The market revised the price-earning ratio first. Sometime, in the early part of 2015, in the month of March, the market actually realized that, that expectation was not getting matched.
Right.
So what did we do? We de-rated the market to such an extent that, we became extremely pessimistic about the earnings growth. And that was a situation that we were in February of 2016, when we brought the Nifty down to a 6,800 level. And then we saw that, there is now an uptick in the earnings that we are beginning to see. And I think this overestimation and underestimation of the earnings will be part and parcel of the market.
Fair.
But earnings may not be the only factor which play on the market. The markets at any point of time are a function of 3 factors: liquidity, valuations, and events.
Right.
And we need to calibrate all these 3 into the assessment as to what the market direction will be in the short term, medium term, and the long term.
That is exactly what I was going to come to, and I'm very glad that you have brought it up, because what is the weight of these 3 at the moment? Because, one could argue that the reason why the markets went down or corrected or got derated in February was not driven by earnings estimates at all. It was essentially because liquidity vanished from the markets because interest rates were raised in the US. And at that time, the Fed was saying that we are not only going to raise interest rates in this particular year, in 2016, we are going to raise it 4 times. So that is why money flew out of India, liquidity dried out, and that is why it got derated. It had nothing to do with earnings expectations at that time.
So therefore, I believe that today, if you see why is it that the markets in India and globally are correcting, because they see that both these 2 factors, event and liquidity, are correlated. The expectation that the Fed will raise the rates in the September meet gives rise to the speculation that this will also suck out liquidity from emerging markets, and in which case India will also be enveloped. Now, if you look at as to what has been the trend of liquidity in the current year, calendar year 2016, you have a net inflow of close to about 42,000, 43,000 crores from the foreign institutional investors.
Right.
Against that, the domestic mutual funds disclosed number is about close to 11,000 crores. Calendar year 2015 was a contrast because, in that year, you actually had the domestic mutual funds being net buyers to a quantum of, I think if I recall correctly, maybe 2 to 3 times what the foreign institutional investors had bought. So this apprehension that in case the Fed is going to raise rate, and that is the event, the liquidity that has been supporting the market, that will evaporate. Now, this view can get negated because, if you've seen the trend of the numbers, the month in which the GST got passed by the parliament, the gross inflows to domestic mutual fund was 20,000 crores. The day the markets fell, which was on Monday, the retail inquiries to invest money into the markets was very high. So I guess that, markets, if they trend to a particular level, the attractiveness of the market on the third factor, which is valuation, will make it attractive both to FIIs as well as domestic institutions.
I think that's a very important point you've made, and that is what I wanted to ask you about. Do you think that there's been a significant change in which the retail investor now views the market? Maybe 10 years ago or even 7, 8 years ago, they used to buy the stock which was going up. Do you think that retail investors are increasingly becoming valuation oriented?
Yes, I think, the experience right from the debacle of, if not 92, 2001, 2008, has made the retail investors a little more, I will say, mature in terms of how they perceive equity. That is getting translated to some way in the way that the enduring flow that is coming to the equity market, thanks to the, the close to about 10 million plus SIP accounts that contribute about 3,000 crores on a monthly basis. Also, because of the institutional flows that are now coming through the NPS route and the EPF route. So, therefore, there is an institutionalized flow to the market where the retail investor is not very sensitive to the market level. The other flow, which is the one which is tactical in nature, I think that flow at all classes of investors within the retail, the HNIs, the mass affluent and the mass retail, I think that amount that is coming to the market has now started looking at markets at levels. Today, I think the knowledge in terms of what is the absolute right level of the market, I think that knowledge may still be lacking. But notionally, that the market looks attractive at 8,500 points, the market looks expensive at 9,000 points. I think that amount of awareness has surely come to the retail investors.
A lot of times we talk to people like you who are investors, who understand and have experience, and you say looking at market levels beyond a point is meaningless because you're investing in individual stocks, right? And therefore don't look at these market levels. But it's also true that it's very difficult right now to find even individual stocks where you find bargain or value which would have been value investors look at. Is there a change now increasingly towards looking at good companies, looking at qualitative companies which have good management, good corporate governance, have given good ROE, ROCE over a period of time, have good cash flows, and not really project that much, but be more backward looking? Has that been a change now?
I think that is surely there because let me share one data point with you. We did an analysis as to, how did the market behave between, say, June 2014, when it was, the Sensex was at 25,000 points. April of 2016, the Sensex was again at 25,000 points. So if you had put your money into the market, you would have actually made 0% return.
Right.
During the same period, equity mutual fund as a class gave you a return of about 14%. I know equity mutual funds are made up of all types of funds, good, bad, ugly. But the fact is that, there is a professional manager who's making the stock picking and is applying a reasonable, structured process by which he is analyzing stocks, is the one which is telling you the story. I think, you have very rightly said that, at the current level, much of the gains that the markets could have given you, I think that easy gain is now behind us. From here onwards, the market's general trajectory might be a function of many factors. Liquidity, of course, will be one of the significant ones. But the individual stocks will continue to deliver returns if you are very good in terms of picking up those stocks. So the story from now, at least for the next 12 months, till the time that the macro situation becomes much better, I think the next 12 months will become will reward the stock picker more and not generally those who are going to put money in the markets in general.
The reason I was asking you that question, Mr. Sinha, is that earlier when we used to ask big investors, big fund managers, they would talk about future earnings. They would talk about discounting the future. And obviously all valuation models would be based on that. Now increasingly I'm hearing people like you talk about what was in the past. So if someone says this company has continuously delivered whatever the market numbers are, if I look at a 10-year period, this is what happened because it has continuously good return on equity, it has good return ratios, it generates cash whether or not it shows up in its at the end of the day, the accounts that come out that we look at. And there's much more balance sheet analysis rather than P&L analysis that we are seeing at least in this year. Are you also in that school, which is now looking more backward and saying this company has a track record? It's better to be there with higher valuations, even if it looks expensive, than be somewhere where everything is future, earnings are all coming 2-3 years down the future, in the future.
So, one part, which is that looking at the quality of management and their capacity to deliver in the past is one aspect. But many of the current crop of management, also from existing businesses, many of the existing businesses which are, I will say, family-owned businesses, have seen a new generation of owners stepping into the management seat. And these people are more conscious that the market rewards the quality of management by way of market capitalization more than it does the reward the company by way of the company's activity in generating a higher level of profitability. Now this new crop of owners or managers are also setting standards where some of the companies which were on the I would say on the negative list because of issues of corporate governance in the past are now also companies which have become I would say favored by the market, because there has been a significant change in the quality of management, both in terms of their respect for shareholders, in terms of the value that they look at delivering to the shareholders, and so on and so forth.
Okay, I know you cannot talk stocks, and therefore I've tried to keep it as macro as possible, but I'm going to just ask you a few sectoral questions, if that's okay with you. I want to start with IT. Now, your own view, do you think IT is over? Indian IT is over. It cannot give any, it will probably be high single-digit growth, and therefore it doesn't deserve any relative valuation more than maybe 10 times. And even at 14, 15 times, it is expensive. Do you belong to that camp, or you think that Indian IT will come out of this problem and probably go back to high growth stage?
So I think the concerns with the Indian IT sector is more to do with the near-term view on the sector. The IT sector came into its own and started occupying a significant position in the investors' allocation right from 2000. In the last 16 years, it is not as if the sector has not faced challenges which has come from various quarters. Whether that be visa, whether that be IT allocation of large companies. And mind you, 2008, when the great financial crisis hit the world, IT sector actually had to take a hit during that time also. So I think today, what is the cause for concern is the near-term visibility of the earnings of the IT companies. Now, whether we are questioning the ability of the IT companies to reorient their models to accommodate the newer realities, the Internet of Things, big data, digital strategies, so on and so forth, I think on that the doubts are much less. So the near-term concerns are there, but I don't think, as a sector, it will be a sector that will be absolutely discarded, because, we've seen similar thing happen in the FMCG sector in India. These companies were expensive, continued to be expensive, and kept on coming back in the investor reckoning because of what value they delivered as a company.
So if you're a long-term investor and you're getting IT companies as 14 times, big IT at 14 times, and if I take out the cash component that they have behind them, probably at about 11, 12 times, and if the overall market is trading at 18 times, would you be a buyer in IT right now, and as a long-term investor?
Yeah, I think it would make sense to have an allocation to IT in your portfolio. Even in the event of, say, a market volatility, I think it is one sector that will act as a defensive bet in your overall portfolio allocation also.
In telecom, is this a space that you would completely avoid for the time being because Reliance Jio is in there?
So I think, Reliance Jio's entry, in my opinion, actually is going to improve the prospect for the telecom sector over a period of time. This entry of Reliance Jio has caused fair amount of trepidation, and I think it is also reflecting in the stock prices of many of the other competing companies. I think as a contrarian call, it will make sense to accumulate a little bit of telecom, because as a sector, while it has not delivered anything significant over the last 4 to 5 years, if you see, one of the key things that is going to happen now is the adoption of data over wireless. And I think if that is going to be a change that is going to be initiated by a big player, the other existing entrenched incumbent players will also be the beneficiaries of that opportunity.
So within that space,
I think it makes sense now to start accumulating telecom.
Within that space, would you want to be with someone who doesn't have to spend too much on spectrum right now?
Well, that might actually not be a choice at all, because this is, we have an auction which is coming up in the near future.
Yeah.
That, in my opinion, would be the last factor that you should be looking at before starting to accumulate, because depending as to how aggressive this auction is going to be, will also determine which companies will be the ones which will convert the opportunity into a more profitable opportunity, and then just being a market player there.
Do you think that some of these telecom stocks are also, companies are also perfect acquisition targets in the long run because of the consolidation, and therefore their valuation might go up?
That would be difficult to predict, because it would be very company specific, will depend upon at what stage of evolution of their business model they are in.
Okay, one final question to Mr. Sinha, and that is about the monsoon. Today the newspapers have been reporting that monsoon is slightly below normal, the long-term average. In fact, it, as of now, I think it is about 5 to 6% below normal. One paper has reported that the IMD says that it has got its call wrong. In another paper I've read today that the IMD is actually saying that no, we are confident that it will be 6% above normal. If it is below normal, do you think that there's going to be a significant change in the earnings and the way in which the markets are looking at agri-facing, consumption-oriented counters?
I think that may not happen. My view is that, to a large extent, monsoon is one of the significant factors which is going to support consumption in the country. But if you recall, in the union budget itself, a lot of programs and projects were announced which was intended to direct investments to the rural areas.
Right.
I believe that, after 2 years of fairly deficient monsoon, this year, if we do not have a bountiful monsoon of a 6% above average, I think by and large, except for certain pockets, which that same paper has reported, confined to a few states, by and large, the country has received fairly adequate rainfall.
Right.
So I think the consumption story is very much in place. And I think, there is also a supporting story, which says that 40,000 crores of ad spends have been lined up in the festive season in the anticipation that, a good monsoon will also lead to a good consumption play. So I believe that the consumption play is very much in place.
All right. Thank you so much. Consumption play very much in place. That's the positive note on which we'll leave you. Thank you so much for taking out time for us, Mr. Sinha. Pleasure talking to you.